All right, awesome. Thank you, Mark, for being here. So I am Jennifer Davidson. I'm president of the Nebraska Council on Economic Education. And here with me today is Mark Wynegar, who is president of Tributary Capital Management. He's also a board member of the Nebraska Council on Economic Education. So thanks for being here. And really my purpose today is to help our stock market game teachers specifically better understand this whole crazy GameStop, Reddit, Robinhood that's been going on for about a week at this point. So I know that they're getting questions from their students and they've contacted us for some help. And so I just thought, you know what, we have an expert. Let's just get him on Zoom and we'll do a little recording and send it off to our teachers. So with that, let's just start by, can you summarize the issue that's going on with GameStop?
Sure, absolutely. Great to talk to you today, Jennifer. So, I think to understand what's going on with GameStop and kind of the overall situation, it's probably helpful to start with, what is the catalyst for the whole situation? And I think the starting point is the fact that there was some short selling going on. And I think the natural question that becomes from that is what is a short sale? So ordinarily, I think a lot of us think of investing of, I want to buy a company and I'm buying the company because I think the stock is going to go up. I mean, ultimately, that's what a share of stock is. It's an ownership interest in a business. If you think the business will do well, then you should expect the stock will go higher, and that's why you would buy the stock. Now, there's another school of investing that says, well, what if you think the stock is overpriced relative to the value of the business? If I think the business is worth something less than where the stock market is pricing it. Well, there's certain investors, among them in this case was hedge funds, that engage in a practice called short selling. That means I'm selling a stock I do not have. And the reason I'm selling it is because I expect it will fall and then I can buy it back at a lower price. So I sell a stock at $100, expecting it to fall to something less than $100. And then I can buy it back at 90, 80, 70, something lower, and make money by buying it lower than I sold it for. So it's kind of a backwards way of looking at investing. So basically, when certain investors think that a stock price is too high, that they would engage in this sort of practice. So there were investors with GameStop who felt that the value of the business was less than the share price. And those investors sold the stock, expecting it to fall and they could buy it back at a lower price. Now, what happened was there was another group of investors, and among them, these group of investors on Reddit, that felt that the stock was worth more than the share price was indicating. So they decided to buy the stock, as is their prerogative, to buy a stock you think is worth more than the share price. What happens, now this is, I think, an interesting way to think about short selling. When you buy a stock, you expect it to go up, and so you make money if it goes up. If you buy a stock and it goes down, you lose money. That's how ordinarily we think about investing. With respect to a short seller, you're expecting it to go down so you make money. But what happens if it goes up is now, as using my example from before, you sold it at $100 and now you have to buy it back at 110 or 120 or 150. Now you're losing money the higher it goes. And so what happened was the number of buyers, the Reddit crew kind of overwhelmed, and they pushed the stock so high that the short sellers started losing money because they were going to have to buy back this stock that they had already sold. And that is what engineered what's called a short squeeze, in that they are so desperate to buy back the stock because their losses are mounting the higher it goes, that then it starts to feed on itself. They are buying it back. The people interested in owning the stock are buying the stock and pushing it higher, and it starts to feed on itself. And that's exactly what we saw with GameStop and some of these other stocks last week, was that the buying was so aggressive. The short sellers were basically losing money the higher the stock went, and it became a very almost perpetual motion machine, that the number of buyers was overwhelming the amount of stock there was available, and they kept pushing it higher. So that's kind of in a nutshell what happened. There was lots of reasons behind that. There was lots of discussion that even started earlier in the year of some investors expressing opinions on GameStop, favorable or unfavorable. And it really culminated in a massive short squeeze last week, which pushed the price of GameStop to what we're seeing recently.
Okay, I have a couple additional follow-up questions on that. In terms of short selling, just for the educational purposes, how is it that you sell something you don't have?
Yeah, well, you have to the way these funds operate is they have to borrow the stock from somebody else to sell it. So I don't have the stock. There are systems in place where you can borrow the stock from somebody that has it so that you can sell it with the hope of buying it back and replacing it from who you borrowed it from. There's programs called securities lending programs where investors can engage in that. By lending their stock, they make a small fee for doing so, and then the short sellers have that available for selling, even though they don't own it. And of course, they're paying that fee, so there's also some cost involved with that to them. So they're looking for I sold a stock, I hope to buy it back lower, and I hope to buy it enough lower that I can make money and pay the fees that are associated with borrowing the stock in the first place.
Okay. And just so you know, we actually, on our stock market game program that we operate at the council, students do have the opportunity for short sales and short covers. So that is built into our program. Okay. Why did the amateur investors select GameStop as their focus? So how did they even find out that there were all of these shorts on it already?
Well, there's a lot of hedge funds will talk about the shares that they've shorted, talk about their positions. I mean, you watch CNBC and you see investors talking about stocks they own that they like. Hedge funds will also talk about stocks that they have sold that they don't like and why they've sold them. In essence, I think this started earlier in the year, and there was a little bit of discussion about the merits of GameStop, and I think a firm indicated that they thought it was overvalued. A group of investors disagreed with that, and that was kind of the underpinnings of this. And then really the whole thing just kind of caught fire as more investors piled into the buy side of the equation that really caused the price to explode last week.
So I've been doing a little bit of reading, and I'm wondering if you can talk about, there's a lot of discussion about the Reddit crew not being happy and really trying to a Wall Street versus Main Street type of situation. Is that what's happening here?
It certainly is part of it. If you look at any of the message boards and see what's posted out of there, there is certainly a lot of angst being expressed. That there's probably an aspect to that as well. And then I think the other aspect is just that the markets are meant to function so that if you have an idea and you're willing to put your capital at risk, you have the opportunity to profit from it or lose from it. And everybody's entitled to their own opinion. The short sellers are entitled to think the stock is not worth that much. The buyers of GameStop or any company are entitled to believe it's worth more than it's trading for. And really, that's kind of how the markets function: is groups of people that think that some stocks are worth more than they're trading for, some are less, and there's buyers and sellers interacting all the time in the marketplace. Really, that happens anytime you sell a stock. If you buy a share of Apple, you are buying it from somebody. You're not buying it from Apple, and somebody has made the decision that I want to sell that share of Apple so that you can buy it. So there's always this interaction of buyers and sellers. It's when things get into the imbalance, the way they did with GameStop, where there was way more buyers than sellers, that things really exploded. We saw the opposite last March, quite frankly, when the markets dropped in February and March of 2020. There were more sellers than buyers, and that's what causes the market to collapse, in that case, crash in that instance. The one thing I would say, and there are lots of different ways to invest, lots of different strategies, lots of different philosophies. Ours is one where we try to look at what we think a company is worth. We keep in mind that these are shares of businesses. These aren't things that we're trading. We're not looking to buy and flip and trade stocks in the course of a matter of hours or days. What we do is we try to evaluate the businesses, determine what we think the business is worth, and then, is the stock price higher or lower than we think that's worth. That is in essence what we believe about investing. It's a long-term approach where we're buying shares of companies and holding them for long periods of time. Um, other brands of investing are more prone to trying to anticipate what's going to happen next in the market, moving back and forth between different buys and sells to do that. But what we try to do with what we do is always underpin this with what is the company worth versus where is the stock price trading. And I think that's a very good lesson for students to understand what actually a share of stock is and what it means and how you determine what it's worth.
I love that. Comes back to supply and demand in terms of pricing. Love that. What's the role and responsibility of the SEC in this situation with GameStop?
So yeah, the SEC's job is to make the markets as fair and as transparent as possible. At the end of the day, they want to set up the rules so that one side can't take advantage of another. And that's honestly, they're looking into the situation of last week. They're looking into, they're always looking into situations in the market to see, was there something unfair going on? Is there some market manipulation? Is there something that is, disproportionately favoring one side over the other? And most of all, is there anything that's fraudulent going on? The issue last week would be, looking at both sides of the discussion and seeing, is there anything that happened that was inappropriate based on the rules they've set up, which is ultimately trying to look out for the greater good of the investing public. And honestly, maintain faith in our markets too.
Absolutely. Question, do you think these types of situations are going to be more likely with the continued influx of amateur investors like those we're seeing on Reddit? There's so many more investors coming to the market. Are we going to see more of this?
It's always possible. I would say this is very similar to a situation that I experienced earlier in my career back in 1999. Technology was a little bit different at that point, but there was kind of a similar phase of retail investors getting very interested in the stock market, making big returns in the stock market. At that point, as opposed to things like Reddit, it was Yahoo message boards and things like that, where people were posting information about stocks. And that was kind of right at the outset of online trading when investors really got engaged in that. So that was something we saw, as long ago as that. I think it's been probably increased here recently because of the fact the cost of trading has dropped so dramatically. I mean, it's cost free from a commission standpoint. Platforms are in place to increase the simplicity of doing trades. But what I would also say is that we kind of go in these waves. These things occur throughout all of investing history. If you look back, there have been a number of times when the public becomes very enamored with investing and people start to ask the question, are things being pushed to unreasonable levels? And that's where we always come back to say, I think the important thing is to understand, if you're owning a stock, what do you own and is it worth as much as you're paying for it? Or are you just hoping for someone to come along that's willing to pay more for it? Because that's the sort of situation that can result in lots of volatility and potentially losses in the stock market.
So that brings up another good point. So all of these people that came in and they're buying GameStop even up through Friday and after the markets were closed, are some people going to lose? Are they going to?
Possibly. I won't make any representation on GameStop, but that's certainly the risk they take. If you buy a share of GameStop at whatever price it is right now, if it proves that the company is worth more than that, then the possibility of you making money certainly is there. If the business is not worth as much as the share price, the potential to lose money is there as well. The market is kind of a price discovery mechanism. It determines, what are people willing to pay for it right now? Over the long run, what it's actually worth is probably going to govern it. So time will tell who's got the right side of this particular equation. But That's where we always think it's very important to understand if I'm paying $300 or $200 or $50 for a share of stock, what do I think that business is actually worth on a per share basis? That's really, I think, a very sound way to reduce risk in someone's portfolio.
General question in terms of investing. Is the stock market a safe investment?
I would say that the stock market on the short term is tends to have these bouts of speculative frenzy. Whether we're in a bubble or anything like that right now, only time will tell. History is usually the best judge of those sorts of things. What I would say is that over the long run, yes, it is a fantastic place to grow wealth if you have the right perspective. If you're treating it like a gambling tool, where I'm buying it because I'm hoping I can sell it for 50% more tomorrow, that sort of mindset has not worked out well for investors historically. Buying something today because I think this business is going to grow its value at 10% a year, 15% a year, 20% a year for the next 10 years, that's a very sound way and a very safe way to invest your money. Buying something on the hopes that a week from now I can sell it at double the price, that starts to get on the boundaries of speculation. And that's what's probably not quite as safe about investing.
Okay, so for our students, I just want to reiterate, buy, hold, think long-term, these kinds of behaviors. So the stock market's definitely safe investment, continue the learning process about it, but feel secure in that if you're thinking long-term, it's a great way to build wealth.
Yes, yep. And I would reiterate those points, Jennifer, to say that to keep in mind that a share of stock is a ownership stake in a business. And if you can figure out what you think the whole business is worth, divided up by how many shares there are, that's the value of a share of the stock. And then you look at the price of the stock and compare it to that, and you say, do you think it's worth more than that or less than that? I think that is a very solid way to go about investing for the long run. I think a process whereby you've read something online that says this is a hot idea and I think this is going to skyrocket over the next month, that is a little more risky way to invest one's money.
Awesome. Thank you so much. Again, Mark Wynegar, President of Tributary Wealth Management, also a council board member. Thank you very much for being here. Just have another minute or so. Do you have any last words of wisdom for our students, middle school, high school students that are trying to learn about investing in the stock market? And their teachers for that matter.
What was that? Oh.
And their teachers for that matter.
Yeah, what I would suggest is to find some good investment books to read. Go and there's lots of long-term investors that talk about the process of how to value a business and how to make solid long-term decisions in the stock market. You'll find some of those books by people like Howard Marks or people that have written about Warren Buffett. I know in this day and age, sometimes Warren Buffett is looked at as somebody that had success in the past and maybe is not quite as relevant today. But the things that he has always talked about, he and Charlie Munger have talked about the idea of owning businesses for the long run. That is a very good mindset to have. And reading things that these investors have written or that people have written about them is a great way to learn about how to be a successful long-term participant in the stock market.
Awesome advice. Thank you so much for your time. Appreciate it very much.
Great to talk to you, Jennifer.
Have a great day.
You too.